Okay, now I'm going to quickly explain closing entries. What you have above is a chart of accounts, or I guess the T accounts for the normal balances. So assets are increased with debits, liabilities are increased with credits. So assets, debits, liabilities, credits, owner's equity, credits. Revenues are increased with credits, expenses, debits, and dividends, debits. So there's the basic rules. These accounts down here are actually part of owner's equity accounts. So this is our balance sheet, and the owners get the revenues, the expenses, and the dividends. However, you want to kind of separate it out for the year so you can keep track of how much income we made in that year, and then you close it into owner's equity and start the new year, and then tell you how much you made in year 2, close it into owner's equity. So the question is, if you keep track of it separately in these accounts for the year, how does it physically get into owner's equity? And the answer is closing entries. There are basically 4 closing entries that you have, and they're honestly not very hard. So just kind of get a rule for, hold on, some general rules of what they are. So if I have this in front of me, it's going to really help me as far as closing entries go, and I don't know why that will not erase. Apologize for that. Okay. So we're going to close these into the expense account, or the temporary accounts down here, to owner's equity. All right, first one, close revenues to owner's equity. Look at the normal balance in a revenue. It's a credit. How would I get it to 0? I need to debit it. So to close revenues, I'm going to debit every single revenue account. Now that balance is 0. And I'm going to put it into owner's equity. So my debit's revenues, and my credit's owner's equity. And notice I've subtracted on the revenue side and plussed on the owner's equity side, or added to the owner's equity side. So now I've simply transferred them out of here into owner's equity. So now owner's equity has gone up for my revenues. Okay, the specific entry for that is to first debit revenues, credit income summary. So step 1, debit every single revenue, credit income summary. Income summary is sort of a temporary account, which I'll talk about in a second. All right, next one that we're going to do is we're going to close expenses. Look at the expenses. What's their normal balance? Their normal balance is a debit. Okay, so what I do for those to close them is I credit them. So basically my expenses have 0, so I've credited my expenses, and I've now debited an owner's equity account, and specifically income summary. So now I have my expense accounts. I'm going to debit income summary, which is a temporary owner's equity account, and credit expenses. My expenses are now 0. My revenues are now 0. And notice what income summary has in it, because I've put my revenues into it and my expenses into it. Income summary has now net income in it to it. All right, so let's hold on a second. Okay, so now I have revenues closed and they're zeroed out. I have expenses closed and they're zeroed out. And I have an income summary account, okay, that remember I've debited my revenues and credited income summary for all my revenues. I've credited my expenses and debited income summary for my expenses. So now, hopefully your revenues are more than expenses, so you have a balance on the credit side. If you have a balance on the debit side, it's a loss. All right, so now my income summary hopefully has a credit balance. If not, you just flip this entry. I take my income summary and close it. So if it has a credit balance, I debit it and I credit owner's equity. And specifically the owner's equity I close is retained earnings. Okay, so now the last thing that I do is I close dividends. Dividends are not income, so dividends do not get closed to income summary. Notice the income summary is actually now 0 because I moved it into owner's equity. Dividends have a debit balance, so to close them I credit them and I debit owner's equity. Notice owner's equity goes down because the money is going out to the owners, and the business, which is a separate entity, no longer has it. And specifically that debit is retained earnings. So there is the summary for closing entries. First one, you close revenues to income summary, then you close expenses to income summary. Third, you close income summary to retained earnings, and fourth, you close dividends to retained earnings.